Why does Savart maintain a concentrated investment portfolio? Investors are often confused between creating a concentrated portfolio or a diversified portfolio. We at Savart believe that it is not only important to diversify your portfolio but also keep it concentrated at the same time. Basically, it is very important to strike the right balance in order to generate returns over a long period of time. Let me explain you the main reasons behind why Savart maintains a concentrated portfolio. Maximized returns. By focusing on its best ideas and high potential companies, Savart's concentrated portfolio aims to yield long-term returns when compared to the diversified one. Deep insight through research. Concentrating on fewer companies allows comprehensive research, leading to a profound understanding of the business intricacies and competitive edges. Investment conviction. With a limited number of companies in the portfolio, Savart invests with higher conviction, ensuring each pick aligns with its core beliefs. Efficient resource utilization. A concentrated portfolio ensures the best use of Savart's resources, optimizing both research depth and investment potential. Tailored focus on growth. Savart's targeted approach ensures an emphasis on companies with the highest prospects for growth and profitability. Moving forward, let us talk about diversification is good in moderation, otherwise kills returns. Let me explain you this with an example for your better understanding. Think of diversification like an ice cream sundae, a scoop of chocolate, vanilla, and strawberry, making it a delightful mix. But if you keep adding every flavor available, it can make it into a mushy mess. Similarly, investing a little bit in many stocks and sectors can actually protect your money. However, spreading your money too thinly might mean that you might miss out on the bigger gains from standout performers. For instance, if you have 100 different stocks and only one performed well, the impact on your overall returns would be minimal. But if you had 10 stocks and one soared, you'd feel the benefits much more. So here, balance is the key. As Buffett says, bet big when confident. Warren Buffett, one of the world's most successful investors, is known for his philosophy: when you find a good stock, invest big. This reflects his belief in a concentrated portfolio approach. Rather than diversifying widely and thinly, Buffett emphasizes on the value of understanding the business thoroughly and keenly before making a significant investment. Buffett has said that he is willing to invest more than 20% of his portfolio in a single company if he is confident about its future. This is a very concentrated approach, but it has worked for Warren Buffett over the years. Here are the reasons why Buffett believes in betting big when confident. It allows you to focus on your best ideas. When you have a smaller number of companies in your portfolio, then you can focus on the companies which you think have the most potential for growth. This can lead to better investment decisions and higher returns over a long period of time. It forces you to do your research. When you are investing a significant amount of money, you need to be sure that you understand the business in and out. This forces you to do your research and develop a deep understanding of the company's competitive advantages. It shows conviction. When you are willing to bet big on a company, this shows that you have a lot of conviction in your investment thesis. This can lead to better decision making and generate better returns over a long term. We at Savart do not add new stock tips every month as it erodes returns and creates a mini mutual fund, while investors seek better returns than an index. At Savart, we believe that it is important to focus on a few great companies than to try to churn out new stock tips every month. We believe that this approach is more likely to generate superior returns over a long term. Here are the reasons why. It takes time to build conviction. We don't want to add new stocks to our portfolios lightly. We want to make sure that we have a deep understanding of a company and its competitive advantages before we invest in them. This takes time. We don't want to erode returns. When you trade too frequently, you can erode returns over time due to transaction costs and taxes. We prefer to take a long-term approach in investing and hold our stocks for many years. We don't need to create a mini mutual fund. Our investors seek returns over the market benchmark, which we have successfully delivered in the last 3 years by concentrating on a select group of high potential growth companies. To conclude this video, we know that there might be few investors looking for more frequent stock tips. However, we believe that our approach is the best way possible that we can generate superior returns over a long term. For more informative content of this sort, do reach out to Savart.